Yes, thank you. So over the past 50 years, the financial system has evolved quite substantially. And so if you look today, what you see is much more market-based finance than there once was. It used to be everything went through banks. So if you wanted to ensure the stability of the financial system 75 or 100 years ago, then ensuring the stability of the banking system would be your primary objective. And you could do this by lending to banks. And so central banks developed the capacity as the lenders of last resort to lend to solvent but illiquid institutions to ensure that there weren't bank runs and panics in the financial system. As the system evolved and bank importance has declined, the problem has shifted. You still have to ensure that banks remain stable, but now you also are concerned with markets. And the question is, how do you ensure the stability of financial markets? If lots of people in the economy are obtaining financing by issuing securities in markets, the operation of those markets becomes essential for the provision of credit to the real economy. So how is it that you do this? Well, there are a couple of possibilities. One of them is that you can, well, there are a couple of possibilities of how you can stabilize those markets should they become dysfunctional. Now, they can become dysfunctional for several reasons. One of them is that the people that are in it become very averse to participating and they leave. The other one is that the securities that they've been trading become suspect. So you can do two things. One of them is you can lend to the people who were in those markets and provide financing to try and encourage them to return and make the markets and to try and get the investors to return to the markets. The other one is that as the central bank you can purchase the securities yourself and hold them for a while and support the pricing of that. Now, the central bank is probably the only institution that we have that can do this because they have a balance sheet and they have the ability to lend and to purchase. And so the question then is how they should do it. And we've been trying to examine how to build a framework so that central banks can operate as enhanced lenders of last resort beyond just lending to banks and as market makers of last resort, purchasing securities when they believe that markets become dysfunctional. Well, I think that in this particular case, right, in this particular case, I think it's that by helping markets, you get away from the problem that you're just helping banks. And remember that a lot of the credit in the economy is increasingly going through markets. So for instance, in a number of countries, you see mortgages that are being turned into securities, and those securities are going through markets, ensuring that those mortgage securities markets operate. That means that ensuring that people are able to obtain mortgages at the individual level. It's also true that non-financial corporations issue securities, they issue bonds, primarily large companies, but even so, those large companies have to be able to obtain their financing in order to maintain their businesses, maintain the employment of their workers. And so I think that this shift is actually a shift away from just supporting the financial institutions themselves and towards ensuring support for the real economy more directly.